Now, the Reserve Bank of India will announce its mid-quarter review of the monetary policy on Monday, and with industrial growth at a 9-year low, inflation beginning to play spoilsport again, the RBI's options seem rather limited, but the markets have factored in some relief. Let's go across to Simran Gill, who has polled more than 20 bank treasury heads and CFOs, and let's find out what the market is expecting. Simran.
Well, this time around, we absolutely don't know what we should really expect, because on one side, there is growth that is slowing down and is at a 10-year low, and on the other side, inflation is rising again, and it's at the highest levels in 2012. So certainly this time around, the RBI's decision is going to be much tougher. But of course, markets seem to have factored in a rate cut, and an ET Now poll suggests that majority is expecting a 25 basis cut in the repo rate, and majority is not expecting any cut in the CRR. Though there are a few optimistic people out there who are expecting both a cut in the repo rate and the CRR. And lately we have heard most bankers say that they are strongly demanding for a cut in CRR because their argument is that it is a more effective tool for policy transmission. And of course, yesterday we had the SBI chairman talk to ET Now, who said it very clearly that if there is a cut in CRR, then only there will be a reduction in lending rates. And of course, moving on to inflation, majority expect the FY13 inflation projection to be between 7 to 7.5%. And of course, GDP to be between 6 to 6.5%, much lower than the 7.5% levels we were talking about not very long back. And of course, with the downward bias in interest rates, majority is also expecting the 10-year bond yields to peak at a level of 8.5%. So, but keeping all this aside, of course, we did hear Governor Subbarao say yesterday, and he made his intention somewhat clear, saying that to control inflation, there has to be some amount of sacrifice in growth. So will he cut rates or not? We'll have to wait for just another 2 more days.
You cannot control inflation without sacrificing some growth. After all, you have to contain demand. And when you contain demand, growth comes down. So there is no way of bringing down inflation without sacrificing some growth. The exchange rate is market determined, which is our great strength. So that's one reason why we will not have a crisis of the 91 type. There are, of course, other reasons. We have $285 billion of foreign exchange reserves. Of course, we are a $2 trillion economy today, as opposed to 1991 when we were maybe $200 billion. So we're a much larger economy, but we have much larger war chest. Of course, the reserves are made up of liabilities, but regardless, there are our reserves. The third reason we will not have a crisis of the 91 type is because our financial markets are resilient, are robust, are more sophisticated.
All right, so all eyes on the RBI and what it will do on Monday. We've got Jayesh Mehta, who's country treasurer at Bank of America Merrill Lynch, joining us on the show. Jayesh, would you say that, the markets are once again confused? You had another signal come from the Reserve Bank of India that you shouldn't expect anything. But do you still expect a quarter-point cut on Monday?
Yeah, I think markets really confused. Yesterday, I think people were more or less sure that there will be a cut coming in with the governor's statement. Yesterday, people are now having a second thought on that. But maybe the way I would look at it, his statement was more about the past, where we had the growth suffered, particularly the last quarter, and I would still expect at least some cut. So yeah, previously where we were looking at say 0.25% CRR, 50 basis point, a 0.25% repo, 50 basis point CRR. Maybe now you can taper down your expectation to maybe just one of them and live with it.
How disappointed would you say the bond yields would be into reading the GDP numbers as well as the inflation numbers?
I think inflation number was more technical because there was a sharp rally just before the inflation came out, and people, changed their expectation from day before, just half an hour before they started expecting it to come maybe at 697 levels. But if you look at the overall consensus was at 7.5 and it came at 7.55. So I think from inflation number, it's not that disappointing. Market action yesterday was more due to technical rally which happened just before the inflation number came out. So I would say that would be a more technical part of it. And, we did have a good run on the bond prices. but today's thing is really showing the confusion in the minds of people, whether the cut is happening or not happening. So it's like really divided view right now.
Right, but Jayesh, for the markets, between a CRR cut and a repo rate cut, which you just said, it's most likely that you'll see just one of the two. Which cut would the market cheer more?
It depends which market we are looking at. Like if you look at purely the bond guys, for them, repo rate cut would be long-lasting. CRR cut would be yes, there will be a rally, but a very interim short, not long-lived rally. For the the loan markets or the corporates, the reduction in rate, as a lot of nationalized bank chairmen have been saying, will get really transmitted if there is a CRR cut. So from the industry point of view, yes, they would prefer CRR cut. Bond market, of course, would prefer a repo rate cut. But in either way, whether it happens tomorrow or does not happen tomorrow, I think the trajectory as of right now looks like globally and locally is we are looking towards interest rate coming off cycle. And even if it does not happen in this policy, the expectation would be quite built up for the July policy.
Jayesh, given that liquidity management and supply side pressures seem to be the call of the hour, would you agree that it's a combination of a CRR cut plus orderly injection of OMO action that would resolve the liquidity situation in the system?
Yeah, they have to. Like right now, if we look at as of right now, it's not that, it's like 75,000 crores or so. But with the advance checks flowing out from today to next 2-3 days, that would actually go up to almost 140,000 crores plus, right? And you would need some injection, and OMOs will not be able to bring that large injection. It has to come through CRR cut.
And what about the trajectory that you're penciling in for the yields on the bonds? Where do you see it headed?
I think, if you look at technicals can, you might have, good days, bad days, it can happen. But I think overall trajectory, we are looking at the bond yield going down. 10-year definitely looking below 8%. Now again, when we talk about 10-year, are we talking new 10-year, old 10-year? So that's the one difference. Like if you look at old 10-year, it is still at 835 levels, 839 levels. So that is where we are looking that to move down dramatically, maybe to 805, 8 levels over a period of time, maybe another 6, 8 months, 9 months.
And Jayesh, just focusing on the rupee, where do you see it headed? Do you expect that it will stay below 55 at least for the next maybe 3 to 4 months?
I think that's where the big guess is, right? Is we have to all wait for the Greece effect, which is we'll come to know on the election, which is on 17th. And then after that, what is the stance RBI takes? That's important because as of right now, RBI has been intervening, but it's been intervening in a sporadic way, not, addressing it from all directions. So maybe after the Greece situation, we'll come to know more on the thoughts there. So as of right now, it's very difficult, but yeah, maybe today there is only 1 day left for Greece election and the policy. So we were expecting it to remain between 55, 56, which is where it is right now.